my mind. Looks like we're in the clear, just living the life.
What is going on, you guys, and welcome back to another video. Today's video, we are going to be finishing off the year with a joint one, and we have in store basically like a market outlook, I guess. I think we're going to call this our strategy or our take on how we're going to be approaching 2022. We got a bunch of notes here in store, Dad, talking about everything from inflation to the Canadian dollar, where we may see opportunities. But first and foremost, how are you?
I'm very well, Brandon. Thanks very much. Yeah, all good.
Good. Well, I mean, I don't know how long this is going to be, so why don't we dive in?
Sure.
I will just ask for those that are watching, take a moment and give a thumbs up. Let us know your thoughts, maybe what you guys are doing in terms of strategy for the new year, what your outlook is. But basically, I think we'll start this video today by doing somewhat of like a look back, kind of like a back look at what happened in 2021. And I think that may actually set the stage for, where we are today and where we see, what we see happening over the previous year. Obviously, I think it goes without saying, we're still here with COVID 2 years later. That didn't stop, and it doesn't really seem to be stopping. But that's like, that's clearly shaken up the global markets. It's shaken up our whole lives, to be honest. And now with this Omicron variant, the Omicron. Well, whatever. This one is, it's at large. It's at loose. Good thing though, however, I'm seeing statistics that it's significantly less impactful to your health, or at least hospitalizations and the symptoms you get. That said, it is spreading quite fast. It does have quite a high spreading rate. That's fair to say, Dad?
Yeah, extremely high spreading state. That we know already. The numbers are in on that. And then, the depth of the illnesses that it causes is still up for debate, and we're learning more as it's getting along. But yeah,
we're not doctors here.
We're not doctors. This is not medical advice. But I have seen reports that suggest, at least initially, that it's not as it doesn't affect you as negatively as some of the other strains. So, fingers crossed that that's the case here. Yeah.
Nevertheless, that is still something that is out, and it's an issue that's present. Another thing that we were just going to chat about was like the supply chain issues that we've seen over the past little while. There doesn't really seem to be any hope in sight.
Relief.
I mean, we'll have to see how that does play out. But of course, I think one of the big things that we're going to be talking about today as well is inflation. And we've had some higher inflation numbers coming up. That may have been something that has kind of shaken up the market, at least in the last quarter of this year, where we've really started to see some higher numbers. But nevertheless, I mean, I think that can kind of, in a sense, summarize 2021. The markets, kind of played out their recovery. They came out of this pandemic, and they did quite well, to be honest, other than the past little while where we have seen a little bit of shakiness.
Well, that's so true. And I mean, clearly the recovery, the strong recovery, was helped by things like the vaccines. That was a huge change, as long as we can manage through that carefully. Another big part of our recovery was, just unprecedented stimulus by the global central banks, right? There's been somewhere in the range of like $16 trillion of stimulus that's been put into the markets. And so with that kind of, hand holding, you would, I guess to some degree, expect the recovery. Interesting, almost the timing on this, Brandon. We did a joint video in January of 2019. January of 2020. So almost 2 years ago.
2019.
Yeah, almost 2020. We did a joint video, and I think it was like a Q&A type video. And one of the comments that I made, or the question was, do you see signs of a recession coming up? And I remember vividly saying, all of the metrics that I look at, all of the indicators of a pending recession just weren't there. So my comment was, I don't see anything. And then, of course, about a month and a half later, COVID hit, and we got whacked. And so it's one of those. It's one of those reminders, I guess, because I think I did my homework and my due diligence properly, but there's these things that come out of nowhere, and I'm reminded of Black Swan events. I'm reminded of a quote by Peter Drucker: "The best way to predict your future is to create it." And this is a reminder that we really can't predict the future. There's so many things that happen out there, but what we can do, and that's probably what we're going to do in this video here, we can analyze what's happening out there, and then we can assess what some possible outcomes might be, and then from that we can just position our portfolios to weigh ourselves in something that we're comfortable with, and so hopefully avoid any big slams. But so true.
And I think that's, not to cut you off, I think that's the name of the game with investing, right? It's to kind of survey the landscape, right? nobody here has a crystal ball. None of the viewers here can anticipate for 100% certainty and to like 100% degree of what's going to happen. But what we can do is kind of look at all these not metrics, not the word I'm looking for, but just indicators, conditions that are kind of pointing us either to say, hey, long runway ahead, or hey, maybe we need to be a little more careful. And I think that's more or less. I mean, you just said that, but I just repeated it. But it's all good. Sorry,
you reinforced it.
Yeah.
Well, we can agree on that. Now, what's interesting, I had a look, Brandon, at sort of some of the large investment institutions down in the States as to what they're predicting for 2022. And, we talk about this, the latitude you need when you're making these predictions. And when we look at some of these, I mean, the big brokerage houses can't even agree. For context, the S&P 500 is around 4,700 today at that level. When we look at this table I pulled up here, we've got a range of where will the S&P 500 finish 2022, and we've got 4,400 on the low end, all the way up to 5,200 on the high end. So that's a pretty significant range, and most are somewhere in between. But the only company or the only institution that is predicting a decline in the S&P 500 this coming year is Morgan Stanley at 4,400. And I've read a lot about that call, and they're obviously the outlier here. The majority are saying somewhere in the middle, 5,000. And so I tend to agree with this. I tend to agree with sort of a more moderate increase in the equity markets, but not a big year, but certainly I would not be surprised if the year ends up in positive territories. And when we think about what our expectations are, the conditions kind of in a weird way are actually pretty good for equities. So
I agree. Yeah, no, I agree. They actually are pretty good. I think where a mistake people could find themselves thinking is if they're measuring the past couple of years' performance and kind of thinking that's the benchmark. I think we personally are setting our expectations lower than that, because coming out of the pandemic, like, we have been really, really roaring, honestly. And again, like roaring, I think is the fastest recovery ever in history. And the returns have been very, very tremendous. Again, other than a little bit of shakiness towards the end of this year. But as you said, as our economy starts to kind of get back to normal, again, Omicron kind of hovering there is a big maybe, or a big thing to consider. But it's not like, it's not like I guess the sky's falling is what you're saying.
Well, to your point, and when we think of the big hit we took in March of 2020, I mean, we've transitioned from a reopening of the economy, and it was shut down. So there's going to be, and there has been, tremendous growth coming out of that, but we're going to be getting back, I believe, to more of a normal scenario. I believe we will see some returns in equities, but probably more along the longer term averages.
Maybe single digits. Yeah, maybe single digits. I can't help it, just the way my brain thinks is when you look back at the annual calendar returns, you just look at a table, it shows annual calendar returns. And I think over the past couple of years, we've been the high double digits, right? 22%. I forget the exact numbers off the top of my mind, but you can't see those periods last forever. And, you get the fluctuations, and after a great period, it doesn't necessarily mean that the markets are going to be going down. Doesn't mean that we're expecting a 30-40% crash or a calendar year return, but just something a little bit back to more normal. And
regression to the mean, right?
Regression to the mean. I think, in my opinion, at least, the conditions are almost set for that. Again, assuming we don't, go into, let's say, another lockdown because of Omicron. Again, we always have to keep that door open. I don't know. I'm not a scientist, so I don't know what the plans are there. But that's just something, living through that recently is always something to consider.
We can't get out of our minds, for sure. No, that's true. And as long as, I'm gaining more confidence as time goes by that the manufacturers of these, the medical, the vaccines or the therapeutics they have a much better picture of what's happening now than they did a year and a half ago. And so even now with the Omicron, they're talking about having a specific vaccine, if necessary, by March, I think is the last time frame.
Another one.
They're talking about, and the nice thing is about these mRNA vaccines is that they can tweak them apparently quite quickly to, they look at what's the new variant is, and they can make those tweaks. And then, what it means though, of course, is another round of vaccines. But at least they now have learned much. It's like sink or swim. You jumped in the water, you have to learn how to swim, and they've learned by trial and error here how to make those work.
And I think I think I'll just chime in and kind of give the viewers what they want to know. So what you're saying, stocks to buy right now is Moderna, is that's what we want.
well, I think we're going to talk about this a little later, but certainly healthcare is a stock that we want to have in the portfolio. Okay. But so Moderna
I'll take a step back.
Might be one of those. Let's look at a little broader scale, Brandon, and from a past the medical field. But we talked earlier about this sort of the supply chain issue, and there's a lot of inventory demand right now. So there's all the stress, I guess, on the inventory because the demand is so high because of all the supply chain issues, and we've had the ships all backed up and truckers not getting everything around. There's a lot of pent up demand out there. I think that bodes well for 2022, or at least for the start. That the manufacturers will work their way through that. I mean, always have, always will. So I'm not suggesting that the entire year will be like that. In fact, probably, if we look, later to the second part of the year of 2022, I wouldn't be surprised if those things slow down. But one of the metrics that I do watch quite regularly is the Purchasing Managers Index. And if we look at the PMI chart that I prepared and sent over to you, Brandon, if we look at just a bit of context here, the purple line across the middle is 50. And if the PMI is above 50, that essentially means that it's a growing economy. And if the number is below 50, it means it's a shrinking economy. And so we can see, the huge impact of COVID, obviously, where everything went down. We've seen that strong recovery, but in the last couple of months, last few months, we've seen that PMI level off. And I wouldn't be surprised at all if we continue to see that going down. Now, in and of itself, a declining PMI doesn't mean the markets are stopping or slowing or crashing. It just means that they're slowing, right? So as long as we stay above that 50 line, that's the key thing. And I think we might see that adjust more towards the 50 at some point in 2022. Any thoughts on that, or?
Yeah, well, no, this is not a metric that I follow all too much myself. I know it's one that a lot of economists will look at, and it's a great indicator of what's happening. I think what that goes to show, seeing the PMI above 50, as you mentioned, the things are kind of in place for the market to keep pushing on. To me, I had some notes here on inflation that I wanted to talk about, and it's basically, that to me is showing it's a result of that. It's like things are powering on. Inflation, clearly the numbers are, as I mentioned, a little bit higher at the given point. And that's a factor of, low rates, of course, as you mentioned, the high demand and that tight inventory supply. These are all things that have basically been contributing to that. Not to mention, of course, all the money flooding that we've been seeing into the markets. Maybe a question that I'll ask you, because I'd kind of like to hear your opinion on this. It's the question of the day. It's the question of the month. Is inflation transitory, or is this something that you expect is going to be longer term? I have my opinion on that, but do you have any thoughts?
Well, my initial thoughts, and I'm just going to go back and just sort of lay out what I thought earlier in the year, and my initial take on inflation that it would be more transitory. We saw the huge drop, the huge spike, and then I thought that would pull back probably quicker than it is, but missing from that equation was all these issues with supply chain and everything else. So it's taken longer than I would have expected for things to get back to normal. I would say, if the question is transitory versus long-term, I think transitory versus mid-term maybe. I wouldn't be shocked if, again, latter part of the year, we start to see that come back to a more number, at least slow down, just because they will be fixing some of these issues that are causing this inflation. And we think of quite famously or infamously now, the Fed south of the border was, just adamant, and the administration, that this is a transitory thing. Don't worry about it. And now, they've gotten to the point where they're saying, okay, we give up. It is actually a real issue. Because of how headline that has become, we're starting to see a lot of steps being taken to help with that. So it does give me some comfort, I guess you would say. I did look at a there's a chart that I prepared here, Brandon, talking about the inflation expectations, and you can see on that the expectations of inflation have fallen in the last few months, and so these are all just predictions, of course, and who knows ultimately where they're going to end up. But that's one of the things I would factor in to my decision as to where inflation's going. Also, of course, if we look at what the central banks are doing, a big part of the change that's occurring now is the tapering of the Fed, and we've seen some enormous money, some buyings of the bonds and the mortgage-backed securities over the last year plus, and so that is very inflationary of itself. Now, the Fed has already, of course, indicated that they're going to stop doing that, and depending on the exact time frame that they do it, but it could be as early as probably March. I think is probably when they're going to completely have eliminated the tapering program, or have completed the tapering, and possibly a little bit longer. But early in the year anyway. So I think because of that, again, that shows me that that they're tackling this problem, and it gives me some comfort there.
Yeah. And what's funny, Dad, is like a lot of people, when they hear these types of, they see an article online and they say, hey, this is, we're going to raise rates 3 times in 2022. This is what we're going to do. We're going to cut back on the money or the money supply. Is that inherently a bad thing? Like, is that inherently, people tend to say, they draw that, you know what I mean? They say, oh, this means stock market's going to crash. This is what's going to happen.
Yeah.
Is it inherently a bad thing? I know our answer for this, but
well, I think it's inherently a good thing, but yes, every time you get this news, even though it's headline after headline, month after month says they're talking about tapering, they dissect the Fed notes and they go, yep, they're talking, it's coming. Well, when it's announced that it's coming, the markets almost always tend to overreact on the downside, but they're tapering because the economy has recovered and continues to recover.
It's powering on,
It's powering on. And, a quick analogy that I've always thought in this regard is, you have your 1-year-old and you're teaching this little child how to walk, and, their legs are strong enough, they just don't have the balance, and you walk behind them and you hold their hands to help them. And that's kind of what the quantitative easing is. The economy is moving, but it's stumbling. So they kind of hold your hands. Well, at some point, you want them to let go. Now, I guess in some kind of a theoretical perfect world, as imperfect as it would be, maybe they just always throw money into the economy, but that's not realistic. And so, I really do see the tightening as a good sign. And I would only say, as far as the central. Well, go ahead.
Sorry, no, I didn't mean to cut you off.
I was just going to say the last point on this. If everything goes smoothly, I see it as a positive thing, and this sort of assumes that the central banks, the Fed here in Canada, don't sort of make a policy error and make some huge screw up that will have a longer term negative impact. Failing that, Brandon, I think that things are probably looking pretty good there.
Yeah, I mean, it's like you said, it's at least investors, I think, of my demographic, people that maybe you would see online and the ones that would share their opinion on this, that have basically been in a really optimal environment for, stock market investing over the past few years. I can't say that I'm old enough to live through periods where interest rates weren't low, right? Like, how crazy is that? Obviously, we can look back at the statistics. We can look back at what the textbook says. I can learn from people like yourself who have been through those periods and say, well, how do we approach this? But I think a lot of people, they've come to believe that this is the norm, that, 0 or close to 0% interest rates is what it is, and stocks are where it's at. But that's not how it historically has been. And as you said, people will see the fact that they're raising rates or and they assume that this is just a negative. This is just kind of getting us back to that normalcy, which I think is sustainable over longer periods of time, right? It's funny. One other thing that pops to mind, it's I see it on the Reddit post, like, people always complain about, this is kind of unrelated, by the way, Dad, but they come.
I'll just listen to this part because I probably don't have much to contribute.
Oh, well, yeah, no, they basically say that the people hate the fact that they keep announcing that they're going to be there's always just announcements about what they're going to be doing, announcements about possibly raising rates, announcements like about what they're planning to do this year. One of the posts that I saw was like, would it be better off? Would we be better off as investors if they just stopped doing all these announcements about for the sake of announcing things and just waited till things actually happen and they actually just said, "Hey guys, we hiked the rate. This is what we did."
Right.
Again, it's kind of unrelated, but that thought just popped to mind because yeah, it seems like everywhere you go, you hear about it over and over and over again.
Well,
And who knows how things will play out, but just a thought.
Well, just an older guy, non-Reddit user, weighing in on that is I have been through eras where the central banks or the governments have made sudden changes without warning, and trust me, they do not go over very well. So
I see.
It's damned if you do, damned if you don't. And of course, like you say, that the media wants to push stories, and that's how they make their money by having people click on their websites or read their newspapers or that type of thing. So yeah, it will always be. But I get it, and it's almost like just stop saying it, do it. But yeah, as investors, that's kind of what we're doing here is we're saying, where do we think the pendulum will swing in 2022? And accordingly, how do we position our investments? So I think this is a better system where you get some data, you collect it, and then ultimately you
Factor in your decision. You
make your decision. Yeah,
that's true. Well, but I have some thoughts here to share on basically maybe what types of, maybe where we may see some opportunities in the market. I don't want to call it a sector rotation or what we should be doing with our portfolios.
Yeah.
But before that, I do see you have some notes on, the supply chain. I think you have actually a really nice chart here, which, if you want to quickly chat about that.
Sure, I'll just chat about that quickly because there has been so much chatting about the supply chain. So yeah, on the chart that I threw up here, Brandon, it just talks about supply chain disruptions, and as we all know, I mean, most of us have been affected, especially here. We're at Christmas and people are talking about not getting their Christmas toys on time. Imagine that. But you can see that historically. Going back to 1948 on this chart here, it's not imaginary. The supply chain numbers are up. Again, very quickly, that does show strength. I mean, I don't want to beat a dead horse here. We've already talked about that. But the low inventories that we've had are, being built up. I think this continues, points to continued growth. So, there's been so much said about supply chain. I think that I just wanted to touch on it because it has been such a topic, and maybe some people have questions. But I think that chain issue will be solved. I read or heard this morning, I think it was, or maybe yesterday, just regarding some new steps that are being put in place to make sure that the goods move around the countries or around the world. Now. So,
I agree in a sense, and then I disagree in a sense. Like, of course, we're not going to stay in this situation forever, but I also don't see it being anything, immediate getting back to more normal. And I could see that, I don't know if you mentioned there a time frame, but like, do you see I didn't. Yeah, because in 2022, first quarter, second, like 2 quarters into the year, I mean, I don't see it getting better, especially with everything that's going on. I could be wrong.
On that, if I had to give it a time frame, and I don't, but I will, I would say I don't see anything major occurring. I see steps putting place in the first half of the year. I can see a partial resolution by the second half of the year. Now that doesn't mean it'll be all fixed, and everything that gets all backed up, it takes a while for that to be moved. But the blockage that we've seen, I think, will ease, and so things will get more back to normal. Full resolution, oh man, it'll take a while. Like I don't know if we'll, through 2022 we may not see full resolution, but will be enough that things will at least seem normal, and we'll be able to get goods in a sort of more normal times.
Gotcha. Well, hey, why don't
fingers crossed on that one too? A lot of finger crossing in this episode. Yeah.
Jeez. Well, let me throw up a chart on the page here. I want to talk a little bit about the Canadian market. Obviously, I know so many of you guys are wondering what our thoughts are on the Canadian stock market, what stocks we're liking, et cetera, et cetera. Actually, this is actually what we find pretty interesting. This was sourced from Refinitiv, DataStream, and Russell Investments. But basically, as of today, it is fair to say that the Canadian market, which is represented here in orange, the valuations are actually looking more attractive at this point than the US market. And we see, for example, on a forward PE basis, 66% versus 95%, price to book ratio, 78 versus 100, and then profit margins, 97 to 100. But nevertheless, as we kind of go into this upcoming year, if you looked at my portfolio data, I have so many, great US investments. And if I did have to be honest, like I'm even lacking a little bit on the Canadian side, but that almost might be a good thing, because now if I'm looking for different opportunities, there are going to be a handful of Canadian names that I personally look for. There's already a bunch of the ones that I'm liking at the moment. Maybe just to name a few for those watching, I've really been liking Kushtar, right?
Yeah.
Manulife is one that it hasn't really been moving anywhere, but in terms of dividend income, I love adding to that name right now. Even the Canadian banks, like they're the
Yeah.
banks, they're steady as they go, but when you look at their valuations, they're so cheaply priced at the end of the day for such a quality business. And investors here, they love investing in those stocks, and so do we. I'm going to be
Yeah.
making a priority on my end and my own personal account to really focus on the Canadian market. And stats like this, again, you don't always want to just compare to the US market, but it may give you, again, just a little more direction as to where to look. And it does seem that the Canadian market may be showing a little bit more opportunity.
Right. A couple of quick points on this, Brandon, because we do tend to compare to the U.S. market, because the U.S. market is the engine of the global investment world, essentially, right? And as Canadians, we do tend to own a lot of U.S. companies, and so I think it's a reasonable comparison.
Sorry to cut you off.
Yeah,
But like, it's fun. I would ask this to a Canadian person, and like, I think this is a very good question to ask. If you're so all about Canada stocks, that you love Canada stocks so much, if you look at your portfolio, how many investors here in Canada would go out and own a bunch of Australian companies, right?
Yeah.
How many of them would own the Australian banks and all these Australian companies? You'd be like, why the heck would I invest in that market?
Yeah.
It's very, very similar. And I bet you the Australian people would be saying vice versa. Why would I go out and buy a Canadian stock?
Of course.
So just to throw in there, but sorry.
Well, there are good investment opportunities here in Canada, but we have to be careful. I think there's this bias. I don't know if this is the official word, but they call it like home country bias, where, and this is global. You tend to want to buy companies that are domiciled in countries that you live in, and so for us, that's Canada. And I've seen portfolios where they're a high percentage are in Canadian companies, to the exclusion of the US or anywhere else on the globe. And just a quick aside, I mean, that's just darn right dangerous, because the portfolios can be so concentrated that, from a diversification perspective, you're pinning a lot on the Canadian economy, but also just think about how small Canada is, our investment opportunities compared to the rest of the world. So by limiting yourself only to Canada, there's a problem there. But Canada is part of most of our portfolios. And so I think the point here is we're saying, if you're looking to re-diversify your portfolio and sort of rebalance things, and typically, very commonly at the end of the year, people sort of sit down and review and go, okay, where am I going to position things for the next quarter or for 2022? Then I think Canadian companies do deserve some attention there. Never forget, there's a strong tie between the Canadian dollar and the Canadian economy and the prices of energy. And, we've seen the price of oil since, we saw it crash when COVID hit, but it's made a really strong recovery since then. There's a few reasons. Obviously, the economic recovery has helped there, but when you look, drill a little deeper down into the energy sector, the supply remains tight. We always see headlines. Thinking of, talking earlier, Brandon, about, hearing things and talking about consumption and OPEC and everything else. Well, consumption was like $92 million a barrel, or 92 million barrels a day back in 2020. That's up to about 98 million barrels per day as of where we are right now. And think of that compared to the supply, the average supply, which is about $95 million. I keep saying $1 million. 95 million barrels a day. So purely from the classic supply and demand perspective, I think we're going to continue to see some upward pressure on the price of crude. I threw up a chart here, Brandon, that just shows about how in the last little while we've seen the price of the crude come down. And accordingly, we've also seen the price of the Canadian dollar come down vis-a-vis the US dollar. So I think that the Canadian dollar is currently undervalued compared to the USD, with this pressure of what I expect oil prices to, with the exception of the jitterness of the COVID from time to time. But in general, I would see that go up, and I would expect the Canadian dollar should rise. And I just showed I gave you a chart here, sort of showing a range. And I'm expecting sort of in the 83 to 85 cent range, which by historic standards would sort of be a more normal range you'd expect to see the Canadian dollar at, given everything else that's going on out there. So yeah, I like what you're saying about Canadian investments. I think that they deserve some attention. You wouldn't sell everything else and put your money all into Canada, but this is where you sort of tweak your portfolio and rebalance, and that's something to pay attention to.
I know a lot of investors ask us these days about fixed income. Like, we actually get those questions a lot. Our students know quite well our opinion on that and what we're doing. But maybe if we just share some general thoughts on fixed income. At this point, I think my portfolio has 5-7% weighting in fixed income, so a very very small component. I just have a small bond component, which essentially, I mean, in a sense, I almost look at it as my cash component. I don't know if we're going to be sharing the exact fund, but yeah. Is fixed income going to be any more attractive than it has been?
2022 is going to see fixed income is going to explode, Brandon. No, I'm kidding.
It's about time.
It's about time. No, let's spend a few minutes just talking about fixed income, because like you are right. We do get questions about it. It's not it's not as exciting, obviously, as the equity markets. It's a much bigger market than equities, but not as exciting. So just sort of in summary, with interest rates where they are right now, they're low. They are, I expect the yields to rise over the course of the year with everything else going on. But I don't see anything too exciting. I would say you expect for a normal, say, Government of Canada bond, somewhere in low single digit returns. Now, fixed income isn't only purchased for the yield. It's purchased as a ballast and as a balance for the portfolio as well. So you always have to factor that in mind and know what your asset allocation that's suitable for you is. And so sometimes you just give up some upside. Well, often you give up upside for the protection on the downside, with the expectation in 2022 that interest rates are going to rise. That will push down the price of bonds. They're inverse there. So I would say for that, if you're going to be making calls in your bond portfolio, I would keep the duration relatively short, just because the longer duration are going to have a stronger reaction to yields going up. I would look at maybe high yield bonds, emerging market debt, corporate bonds, where you may be able to see eke out some more yield. But understand your risk tolerance, because like everything else, the higher you go up that yield curve, the more risk comes into the portfolio relative to equities. It's still pretty minimal. What I do, and I do manage my bond holdings, but I think for a lot of people, there's an ETF that's put out by Mackenzie Investments. It's called the Mackenzie Unconstrained Bond Fund, and I like that fund for people who aren't actively managing the fixed income portfolio, fixed income part of their portfolio. And if we have a quick look at where they are today, or I think this is at the end of October. This chart here, it's the most recent available, but if you look under the sector allocation, they do have a fairly healthy exposure right now to things like investment grade corporates and high yield corporate bonds, emerging markets. So they are, the managers of this fund are just true fixed income experts. And so a lot of time I think that I would just, hand this duty over to them. And in a fund like this, which is basically a balanced fixed income fund, still low when you look at the scale of volatility, it's still considered to be a lower volatility fund, but let them make the calls of where interest rates are going and what you should be doing. So I would say for a lot of viewers, that fund or a similar type of fund where the fund managers have discretion would probably be appropriate. And I could go on and on about fixed income, but I know that people like to talk about it a little bit, but we rarely, get a question. Can you go really deeply into it? So I think that kind of summarizes my thoughts on where we're going to be. Not too exciting, probably for 2022, unless you really decide you want to, ramp up the risk in that sector.
Yeah, we probably just lost like 70% of our viewers in that last segment. Yeah,
I know. Maybe speed it up to double time or something like that during that.
Maybe
time.
I'll cut that entire section out, eh?
Yeah.
Yeah. So anywho, yeah. I mean, for those that did stick around, now we can move on to the more fun part. Maybe we talk about equities and the sectors that we do like. I was just curious. I mean, for those that did stick through that and are interested genuinely in the fixed income side, I'm curious how many of them are essentially being a little more active in their choices with fixed income. Going for either, I don't know who would be buying the bonds directly, like a shorter duration bond, but at least maybe, purchasing a fund with, just in general, an average shorter duration. I wonder how many investors that watch the channel are doing that and making those moves. And if you are, I mean, we'd love to hear you share. At least I would, just for my own curiosity's sake. I assume the number is very, very low, but
Great question.
yeah,
If
I'm
there
just
is
curious.
interest, then I'd be happy to put a video together, focused more on fixed income. Like I say, we
Yeah.
do get the odd request for it, but certainly not universal. So yeah, I'd be interested to know. My take on it, Brandon. I mean, I think fixed income is an important part of a portfolio, but that's for another day.
For another day. And I
Yeah,
think, like I said, let's finish off this entire video by
sure.
talking about what sectors in the stock side of things, the
Yeah,
equity side should benefit. And really the three that I think we've come down to, well, not necessarily just three, but three that I think
right.
are noteworthy.
Yeah.
Simply because of all the factors we talked about today. Um, I think two companies. I joked earlier about a Moderna, but I mean, Moderna is not so much a company we own. I mean, we were buying Pfizer recently for our
Yeah.
portfolio challenge for the public portfolios that we do. Pfizer's a name that I am liking at the moment. I added Johnson and Johnson for my own personal account, just taking advantage of the weakness. But just in general, the healthcare sector is one that, like you said, I wouldn't say a perfect storm, but it makes sense that this is an area that you may want to be in. And it's not that the prices are. I mean, I'm not speaking of obviously every stock out there, but just in
Yeah. Right.
general, it's not like the sector's crazy overvalued. It's not like you're paying an extreme price. In fact, with pockets within it, take for example a Pfizer. Again, I'm liking Johnson and Johnson, but a Pfizer right now. Absolutely. I think it's actually a good value. I know when Ian was doing a presentation with our students, we had Ian on for one of our private sessions with the students. He was talking about AbbVie, one of the stocks that he's been buying and liking. And that was obviously a spin-off from Abbott Labs, but the healthcare sector is without a doubt one that I think would be an area of interest.
I think, given the demographic shift of the world, I think
That
healthcare is
too.
an important part, even in non-COVID times, an important part
Hmm.
of a portfolio. But especially given the situation today, and there's more and more talk about COVID just becoming part of our lives, and I'm not naive enough to think that, oh, this is it. I mean, it's something that the governments are now kind of having to spend more money on, and there's all the testing that's coming online. So I think even in a normal time, healthcare is an important sector to have exposure to, and I think now the conditions would say even more so. If you don't have any exposure to healthcare now in your portfolio, I think it deserves a serious look.
Some other companies that I've personally been liking, and one that pops to mind that I've been wanting to add, especially here in the Canadian market, I've been wanting to get my hands on Power Corp.
Yeah.
I consider that the financial sector here in Canada, very much so. They do have a little bit more to their business than just financials, but they are, in a sense, a play on the financial system.
Big
Um,
time.
Big time. They've done so well, really, over the past little while. I'm waiting to kind of see some better prices. That said, I don't think it's a bad stock to hold at the long term whatsoever. But the financial sector is another one that we're looking at right now as well. I mean, there's very few times that we don't really feel comfortable adding the
Yeah.
big banks. They're pretty awesome to continuously add to. I mentioned
Great
Manulife.
dividend, great yields
Yeah,
on them.
yeah, and maybe to make clear, when I say financials, I'm not talking about the U.S. financials. I'm not talking about the J.P. Morgans, Wells Fargo. Not that those may not be a good value, but for me, when I talk financials, I'm always thinking our Canadian system. Maybe that's the home bias kicking in, but when I say financials, that's exactly what I'm talking about. I think another area that we discussed prior to filming this that we see just continuing to power on is just like the secular tech sector, and
Yeah.
you know geez, again, I don't want to bring up Ian's like what he said because I don't want to just steal what he's saying. But one of the things he said the other day, and it just resonated with me. He said we play in a winner takes all society, and it's these big companies, it's the Amazons, it's the Apples of the world that have just kind of reached this scale and this mass. It really is a force to be reckoned with, and you know it, smaller companies, more niche down companies, they take these hits of, like let's say the supply chain issues. They're the ones that get affected most. Oh
Yeah.
crap, all their inventory is not making it. They're going to be struggling, this or that.
Too
Rates
bad.
are raising.
Meanwhile, the big players have their own ships out there bringing the product across, right?
Well, and on top of that, it's, like, let's say, for example, interest rates rise a couple times over the next year, and you have all
Yeah.
these smaller companies who, may have this debt on, let's say, a variable rate or variable term debt that, they may not have the flexibility to manage that as well as a company like Apple, who just has billions and billions and billions of dollars. It's not a problem for them. They have money to finance basically whatever's going on in our world, and it's hard to kind of argue with these companies as holds going forward.
Yeah. Going back to what we just talked about with healthcare, it's a sector you want to have to exposure to in any event. But given the current market conditions today, the current economic conditions today, and where we're headed, even more so.
No brainer.
Yeah.
No brainer.
Oh, do we just jinx the whole sector? When are we going to put this video up? Tomorrow, probably, and it's just going to be last day. Way to be.
Yeah. Well, I think honest. Yeah. Sorry.
No, I was going to say short the secular tech sector.
Yeah. But I mean, I think we should wrap this up because this video is long as heck, to be honest.
Yeah.
But yeah, hopefully that gives the viewers some just basically more or less discussion style of what our thoughts are. And you mentioned it at the top, Dad. It's not as easy as a matter of just saying, hey, it's black and white. This is it. We are trying to share with you guys kind of the things that have all pieced into our decisions that may lean us a certain way. And I think at the end of the day, like, we're not trying to go against telling people, get out of the US market, get into the Canadian market, get out of this, get into tech, get into healthcare. We're just saying that in general, we want to take our approach that we always take, our balanced, diversified approach, but we can make these tactical shifts to kind of essentially make these plays. And that's what we do as investors, is we essentially factor in the information and we try to capitalize on some opportunities that may lie ahead.
Yeah, that's what it's all about. And I just, you say my summary, I guess, is compared to 2021. I mean, I think the returns will be muted. I don't think we're going to see them like we've seen through most of the year we're just completing now. A couple of big wild cards, COVID, and if they don't get inflation under check, that could change everything. But I'm cautiously optimistic, I guess, going into the new year, Brandon. And it's always exciting to sort of position things and see what's going to happen. And then a year later you go, nailed this one, missed that one. And, that's always the way it's going to be. And like, kind of going right back to the beginning, if the minds of those big US dealerships, brokerage firms cannot agree, well, we're just adding to the conversation. But that's what investing always is, right? Having a conversation, listening to the pros, cons, and then putting your money where your mouth is at the end of the day.
Mm-hmm. Well, thank you guys so much for watching the video all the way through. I think this may be our last video of the year, Dad. We may throw them together, but maybe I'll just say on behalf of ourselves, thank you guys so much for just an amazing year. And Dad, this is I guess your first calendar year on as a YouTuber, right?
My first as Christmas as an official YouTuber. Yeah, I made a couple of cameo appearances previously, but doing this now. And so, yeah, for those of you who have been supporting of the channel. Wow, it's just amazing, and I've just loved the, I guess, 10 months or so that I've been a bigger part of this channel, and so thank you for all the support you've given us. Merry Christmas to everybody, and yeah, just really looking forward to 2022 and powering on like the economy.
Mm-hmm. Yeah, right. Well, if you guys are not subscribed, make sure you subscribe. Hit the bell for notifications as well, and then of course we do have our Investing Academy. This conversation, I would say, if you're just wondering about our academy, this would definitely be suited more towards the advanced program we offer. So the mastery program for those that are wanting to kind of get more up to speed with the economy and look at the sources we use and whatnot. Yeah. For a beginner, this may have been very much over their head. That said, it's great to watch these anyways, to just absorb and to just listen, because although it may sound a little bit, foreign at first,
advanced or whatever.
Yeah, it rubs off. I can promise you that. Not everybody starts like, it does. It really does.
I'm sure. I will just very quickly, Brandon, because I'm sure I may have said this before, but for those of you who, if this was a little bit more confusing or advanced, it takes me back to when I started in the industry in 1994, and I would sit in our Tuesday meetings and I would listen to information like this, and it was just like a foreign language. But keep listening, keep learning. It does eventually translate into something that you can understand and apply to your own investment journey. So yeah, just hopefully you either understood what we talked about. That's kind of the goal. But if not, just keep powering on. Thanks, Brandon.
Or just go back to the very beginning and watch it all over again, and maybe it'll stick then.
It'll resonate. New Year's resolution: every day watch this video over and over till you
get every last bit of it.
Yeah,
for sure.
Awesome.
Well, again, that's our academy down below. Thank you guys for watching. Thank you guys so much for the great year, Dad.
Cool.
I will see you probably soon-ish. Maybe we'll have to see. But
we'll see how it goes over the holidays. Yeah,
we'll see how it goes over the holidays. Yeah. Thank you for spending the time here today.
Okay, Brandon. Thanks so much. Thanks, everybody.
Okay. Talk to you later.
Bye-bye.
Bye-bye.